Thanks to those who have joined. We're just waiting for some more people to join, and we'll start the webinar momentarily. Welcome to those who have joined. We'll just give it another moment or two before we start the webinar. Thanks. Okay, we're at 2 minutes past, so let's get underway. So, good afternoon, everyone, and welcome to today's webinar on the UK Autumn Budget, what it means for you and your clients. I'm Chris Bishan, Head of Wealth Solutions, and I'm delighted to have you join us for what promises to be an insightful discussion. The Chancellor's budget announcement brings a number of implications for taxation, public spending, and personal finances, and we're here to unpack what it means for individuals and financial planning. We're joined by leading tax experts Tony Wickenden and Claire Trott from Technical Connection, who will share their perspectives on the key measures from income tax thresholds and estate planning to pensions and inheritance tax strategies. So thank you both for your time here today. Now, after the presentation, we will open the floor to your questions, so feel free to submit them throughout the session. Now, just a bit of housekeeping as always. The session today is CPDable, and you will receive your certificate after the webinar. And feel free to post any questions into the Q&A section. After the session, please do provide your feedback through the survey. We're always keen to provide content that's useful to you and your clients. And as always, the session is being recorded so you can watch this back at your leisure. Just to reiterate, please do submit your questions through the Q&A interface in Zoom. Now, just turning to learning objectives. So today we're keen to identify key changes introduced in the 2025 budget affecting tax, pensions and financial planning. Summarise the main changes from a tax perspective and their potential impact on your clients, and evaluate how the budget changes affect estate planning and inheritance tax strategies. Now, just to reintroduce Morningstar and give you a sense of Morningstar's global presence and capabilities. We manage and advise on $369 billion of assets worldwide. And as a partner, you gain access to our 400 plus research and investment professionals, all inputting into the investment process and content creation. Now, we also serve 255,000 intermediaries globally, I mean, that's basically 255,000 lessons learned as we regularly engage with that network through various formats and interactions. And it allows us to provide something that's fit for purpose for you. Now, with boots on the ground in over 30 countries, we have local expertise combined with international best practices. So you're not just getting access to our UK capabilities, but to learnings and innovations from intermediaries around the world. So scale isn't just about size, it's about the depth of experience and insight we bring to you and your clients. Now, at Morningstar, we believe in a holistic approach to supporting intermediaries. Rather than offering disconnected services, we've built an integrated ecosystem designed around three core pillars. First, our professionally managed investments bring together global Morningstar expertise across the full end-to-end investment process, so the full depth of Morningstar's analytical capabilities working for your clients. Secondly, our platform takes care of the heavy lifting of administering and housing investments. Our award-winning service means you can focus on what you do best, providing great service to your clients. And finally, our enabling technologies provide advice practice solutions that handles complex data and processes, allowing you to scale your business efficiently. Underpinning all of this is our research data and unique Morningstar insights, the foundation that has made us a trusted name in investment analysis for decades. Now, investor success doesn't happen by chance. It's something we all play a part in. Today's investors face more complexity than ever, and our role is to provide clarity and confidence. Financial advice turns information into insight and insight into action. And that's why we believe it's on all of us to empower investor success. And financial advice is key to doing just that. Now, partnering with Morningstar gives you access to thought leaders and experts, as we are here today, across multiple disciplines, either internally or externally. Our global specialists provide insights communicated in multiple formats, suitable for both intermediaries and clients. And many of you will be familiar with our full program of events and engagements throughout the year. And our flagship event is the MIC, or Morningstar Investment Conference, which we'll be holding in May. So do look out for that. And we aim to support and strengthen your client relationships through comprehensive content, templates, and client engagement tools. These communications are designed to help you demonstrate your value adds to your clients. You'll have access to branded content with all your own use cases, whether it's client-facing, advisor-facing, or more technical in nature to support your investment committees. So now, with that in mind, let's turn to today's session. What does a budget mean for you and your clients? So let's turn to our experts. Claire, Tony, welcome. Thank you for your time here today. No doubt you've been very busy over the past week or so. If you could kindly summarise the main changes that were announced in the budget, but specifically those that will have a direct or indirect impact on tax and financial planning strategy.
Excellent. Thanks, Chris. I'll start and just touch on the pensions things. And I'm going to start with what didn't happen, which obviously we're very happy about, was there were no changes to tax-free cash. We did know that wasn't likely to be the case when it was leaked, or actually announced to the Telegraph a week or so prior, thank God. But we were pleased they didn't backtrack on that, as we've backtracked on a number of other things. We should always remember with that, though, that it is capped. And it remains capped at the 268, 275 or 25% of the fund value, or higher possibly if you've got any protections. So people often forget that, and clients do often forget that it's already capped. So they hear these noises and they start acting, but advisors are very good at calming them. So that's what we rely on. So what did actually happen? Well, again, another leak. We had the leak on the cap on salary sacrifice contributions, and that's what we've seen. So there's a cap on the up to £2,000 can receive the national insurance savings. So that one's coming in. We also saw the confirmation of the triple lock. We were fairly confident that was happening. That had already been stated. And also the fact that they're going to try and take people out of paying tax in the future years if their only income is state pension. They haven't actually confirmed how they're going to do this. It's all around the simple assessment, or they haven't also really considered the fact that there might be a cliff edge there. So we wait for more detail on that. There were also some small amendments to the pensions and IHT stuff that came in the last budget that was announced, which gives the ability for people to retain, or gives the personal representative the ability to request the scheme to retain 50% of the funds and not pay them out to beneficiaries for 15 months, and the fact that they won't be liable if out of nowhere comes a pension scheme after they've been discharged. So they're the real main pension ones that we saw. So nothing of any huge consequence, but we'll go into the detail of those in a moment with any planning opportunities. Pass over to Tony for the rest of it.
Thank you, Claire. Thanks. Got a little bit more, but I'll try not to dwell for too long on it, much of which you'll know about already, and we'll do the detail of some bits you might not have picked up when we do the planning pieces. Right, so we know about those threshold freezes. We knew they were coming. It was just inevitable. So we have the continuation of the freeze on the personal allowance and the thresholds for high rate and additional rates of tax, the national insurance thresholds that go along with that, all through to the 6th of April 2031. Then we have those, we said no increase to tax rates on working people, but we do have an increase to, the semantics of course, but we do have an increase of 2% on dividends, 2% dividends received by basic and higher rate taxpayers, not additional rate taxpayers, 2% on savings income, 2% on property tax, and a new categorisation of property tax. So the dividend change comes in from 6th of April 2026. And the other two changes from 2027. And these are things that we do need to factor into our wrapper choices, I think, when we're looking at how we hold investments and how we, if we can, avoid as much of that tax legitimately as possible. Get into that in a minute. The VCT change wasn't welcome. It starts from the 6th of April 2026. I'm sure there'll be a little spike of VCT interest leading up to that date. The 30% charges drop into 20, but there is going to be an increase in the gross assets and annual investment limits. So that will help companies have more money and hopefully be able to scale quicker, which is the underlying objective. Actually, associated to that, I'll probably mention it now, something that might have passed you by is that there's a call for evidence, which the government have put out to help to review and then improve, if they can, the tax incentives for entrepreneurship. And they're looking, nothing's off the table. They're saying they're asking for any feedback in by the end of February, and then we'll wait and see what the outcome is. But that means, all of the tax incentives across all aspects of what it takes to run and build a business. So that could yield some quite interesting results, which we'll have to watch out for. The ISA cash limit, of course, again, we're expecting there to be some limitation. We now know it's for under 65s only. A colleague of mine was really helpful to me just ahead of this and just shared there was a precedent for when did they test that 65. We haven't got the finance bill yet and the regulations, but there was a position in 2009, 2010, who remembers that, where there was an increased investment limit for those over age 50. And that was if you were over age 50 in the tax year in question. So as long as you were 50 by the end of the tax year in question, then in that case, the ability to put more in. In this case, the restriction on how much you can put in would be the rule, if they follow precedent. So we'll wait and see on that. And also they will look much more closely on how much cash, if any, you can hold inside a stocks and shares ISA so as to not be caught by that provision. I think that's going to be quite tough. What else? For businesses, the employee ownership trust, fantastic sort of ability you had to transfer your shares to an EOT if that was your way out, your capital event for your business, and have no capital gains tax on it yourself. Basically, the whole game was held over. Is only 50% of that is now going to be available, and that was from budget day. Still means 50% will be held over, so that's not bad. An effective rate of sort of 12%, but you'd rather have zero. Capital allowance, a new capital allowance introduced, and then the high value council tax charge for properties over £2 million, consultation on that and to kick in from 2028. And last, on inheritance tax, there's been a lot of pressure for this, and thankfully they've acceded to it, and that is to be able to leave any unused amount of your £1 million that qualifies for business property or agricultural property relief to your surviving spouse or civil partner if you don't use it during your lifetime. They haven't, however, acceded to the pressure, which was, we knew it was never going to get anywhere, I don't think, to be able to hold those qualifying. You can hold them, but you won't get the inheritance tax relief if they're held inside a pension fund. That's right, isn't it, Claire? You're on mute, but I know you can just nod. Yeah, right. And I think, apart from the extension again, just to align up, quite nice, at least it keeps it simple, to align up the threshold freeze for inheritance tax on the residence nil rate band, the nil rate band, and that £2 million threshold for testing whether you taper back. the residence nil rate ban also being extended to 6th of April 2031. And the good news is, and I'll close with this with some good news, that we haven't got a wealth tax. We did have that kind of mini mansion tax, which is pretty widely applicable in many forms across Europe. Many countries across Europe have an extra sort of tax on property in one way or another, but not a full wealth tax, which we know is only around in 4 countries in Europe, Spain being an obvious exception to the no wealth tax rule. But I was interested to see in the FT reporting in Switzerland, which we know has a wealth tax, but also has much lower rates of taxation for reasonably rich people. They had a referendum recently on whether there should be an inheritance tax applied, and they had a 74%. It was introduced by the youth movement or something, the youth socialist movement, this referendum. 74% of people said, no, we don't want an extra inheritance tax. And that was interesting. The rate was set to be at 50, it was 50% it was going to be, but the nil rate band in Switzerland, just to reflect the demographic, was just over 50 million euros. So there you go. Right, well then that and there's the news, basically.
Good stuff. Thank you. Some really good headlines there. Thank you both. So let's deal with the next 2 questions together, and really thinking about things from a financial planning perspective. So, what does it actually mean from a financial planning perspective? But then also, what are those key planning areas? And I'm sort of thinking, retirement planning there, drawdown, and especially that tax-free cash, because that's been very topical in our conversation. So yeah, please, over to you guys in terms of what you think would be really useful from that planning perspective.
Yeah, absolutely. I'm just going to, before we get into the drawdown, I'm just going to touch a little bit on the salary sacrifice and just a little bit of detail there for people to consider when they're talking about this. Salary sacrifice, this change isn't coming in until 2029, so we have plenty of time to get some extra contributions in if you have the ability for bonus sacrifice, an ability to increase personal contributions through salary sacrifice and get those savings. So it might be a case of getting those in, getting them those savings done. Just thinking about how it will actually eventually impact is you can continue to do contributions through salary sacrifice. So it's not going to be a case of completely restructuring the scheme. Most of this will be dealt with through payroll, and up to the £2,000 worth of exchanged salary or bonus, then you will get the full NI saving. Generally for an individual, it's probably going to be the 2% because it's going to be the top part. And then, but for the lower earners, it would be the full amount. And for the employers, it's currently at 15%. And the employer will be paying the national insurance on anything over and above. Employers are not impacted for their employer contributions. So that's not going to be, so a standard employer contribution, say they pay 5% or 10% directly and it's part of your contract, that won't be impacted. They will still get their NI savings, so it shouldn't impact them too much there. Could we restructure all of this? We've got 3 years. Could we restructure all our pension schemes and all our contracts and have everything moved to be employer contributions? Well, technically, yes, but you need to be really mindful of employment law. You can't just offer it to the odd person here or there if they want to do salary sacrifice. You're going to need to make sure that you've got consistent pension contributions. So you wouldn't have that flexibility if you moved everything over to be employer. If you had one person wanting to pay 5%, one white person wanting to pay 10%, it's going to be really hard to do. And the government know that. But the OBR also said that some people may be able to do that if they're smaller businesses, and then they can restructure it accordingly. Talking of small businesses, then if you are an owner, director, shareholder of your own business, and you're used to taking your income either or your profit extraction through, dividends, through salary or through pension contributions, then this won't impact that because you don't have a contract. And that's the important point. In order to do salary sacrifice, it needs to be a change of contract. But if you're not contracting yourself to a certain level of salary and you talk to your accountant and you go, actually, I'm going to have this amount in pension this year, this amount in dividends and this amount in salary, so I get my NI credits, then that will continue to be an option. So it shouldn't impact our small business and paying ourselves. So a lot of advisors on the call, that may impact them personally in their own businesses when they're doing that. So that's just a little bit on the salary sacrifice regarding that. As you say, I think, Chris, the bigger thing here is actually still we're talking about the pensions and the IHT. What we're talking about drawdown, when we're talking about them not getting rid of tax-free cash, people might still be worrying about that, thinking about taking their tax-free cash out and utilising it to get it out of their estate, for example, for the pensions and IHT changes coming in 2027. Well, we've had a lot of people say, actually, the main thing you should do is take your pension first. No, take your tax-free cash out and spend it, take your pension first, which is a complete opposite of everything they've been doing previously. That isn't always the case. And this is where our advisors on the call do the best thing. They're going to look at that because actually it really depends on the tax rates that you're paying in your lifetime and the tax rates your beneficiaries will be paying. It also depends when you die, if you're married, and various other things you don't have control of. So all these things can change as we go through, but having those conversations about how best to take money out, where to take it from to mitigate the tax, and also what the drivers are. Is IHT a driver in death, or is income tax a driver in life? But people are taking money out. So what are they doing with that money that they're taking out? So we see people doing more of gifts out of normal expenditure. So you can take your money out and draw it down. And I know Morningstar do their drip-free drawdown, which is partially tax-free cash and partially income. And so that could be utilised as your income when you're looking at gifting out of surplus income. So all of that tax-free cash and income, industry generally believes that that would be seen as income. And you can utilise that along with any other incomes to have your surplus income, but make sure you document it. The other thing is insuring against the liability. So a whole of life policy. We're seeing more providers come to the fore who are offering to actually insure against this. You could cover it using your gifts out of normal expenditure rules. You could your surplus income, that would actually be fine to cover it there. And just making sure that you have the ability to keep that going, because there is no point in gifting all of this, either doing gifts out of normal expenditure or setting up a whole of life and not being able to fund it for the rest of the time that you need to, because it actually then becomes pointless. We should also always remember that actually we need to think about ourselves first. When I say ourselves, we mean the client. We want the client to remember that actually they might need that money in the future. It's absolutely great to be able to gift the money away, but it's really important to just think about, do I need it in the long term for long-term care? So I'm just going to stop there and pass back to Tony for some of his other thoughts.
Right, yeah, thanks, Claire. Couple of thoughts I might have around the investment, the changes that are relevant for investment choice making effectively. Quite clearly, the 2% increases need to be taken into account. Dividends, of course, hits us from the 6th of April, that 2% extra for basic and additional rate taxpayers, which moves the rate up to 10.75% for basic rate taxpayers and 35.75% for higher rate taxpayers, and it remains at 39.35% for additional rate taxpayers. Seems quite odd for Labour government to let off the additional rate taxpayers. I think the thought was it was high enough already. So what does that do for planning? Well, in relation to dividends, what does it affect? Well, clearly your dividends. Is there a way that you can protect those dividends from taxation? Self-evidently, everyone on this call will go, of course there is. Holding those dividend generating investments inside a pension, inside an ISA, will absolutely protect those dividends from taxation. If you like VCTs as investments with the additional risk, such as it is, and the lower tax relief after April 2026, then all dividends from VCTs, just purely a reminder, completely free of, if that's what drives you, completely free of tax. And then there's investment bonds as a shelter for dividends. Collective investments, as you'll know, generally, and GIAs and all of that, even if you tick the accumulation box, you're still going to be taxed on the income. So if we're looking at bonds, how does it all work for them? We've got two layers to consider. So I think it's worth spending only a short amount of time on this, but worthwhile. If we look at offshore bonds, first of all, the easy one, and there's no life policy holder taxation there. That's why you've got an offshore bond, generally speaking, is somewhere where there's no tax, but you save it all up for when it comes out. Key point here is any gains made under investment bonds are categorized in the legislation as savings income. So you go, oh, right, so it's not dividends. Nope, savings income. In which case, the changes that kick in from 2027 to add 2% to the tax charge on savings income will apply to gains on bonds, unless the finance bill, miraculously, I've talked to a number of people around the sector, the ABI have published a bulletin to member offices saying that is going to be the case. So I'll be really shocked if it isn't. So when you cash in your bond as an offshore bond and you make that gain, you are going to be looking at, 0% if you can use your personal allowance and all of that. But if not, and your personal savings allowance, because it is savings income, as it always was, then you've got a 22% charge if you're a basic rate taxpayer. To the extent the gain falls within the basic rate, you've got a 42% charge when you are in the higher rates and a 47% charge when you come in, which gets people to think, oh, is it worth rebasing the bond, taking money out and going back in before the new change comes in. It might be, I'm sure, lots of calculations will be done, commercials will be taken into account, almost like a sort of bed and breakfast arrangement. Whether there's any anti-forestalling, who knows? But that's where we are currently. With onshore bonds, we've got the two layers. How is the tax going to work inside the UK life? First of all, is the onshore bond gain also taxed as savings income? Yes, it is. It doesn't differentiate. So potentially you as a investor in an onshore bond, after the savings rate change comes in, you could be subject to either 2% tax, because there's no basic rate tax. You've got a credit as it stands at the minute, 2% tax as a basic rate taxpayer, because it's 2% more than the basic rate of tax. Interesting. 22% if you're a higher rate taxpayer, and 27% if you're an additional rate taxpayer. It seems that the general understanding is what's going to happen is inside the UK Life Fund, that rate is going to change in relation to savings income, non-dividend income, and capital gains, to apply a 22% rate. At the moment, that internal life policyholder rate, I'm probably taking too long on this, but I get really excited about it, is anchored to the basic rate of tax. So it's likely to go up to 22%, is what we understand. That keeps it simple when it comes out, because if you're a basic rate taxpayer, you get a 22% credit to frank your 22% liability, and as a basic rate taxpayer, you still don't have to pay any more tax. There's been some more tax taken out in the fund, but you get credit for it. Okay, so that's how that works. If you're a higher rate taxpayer, same thing, 20%, difference between 42 and 22, and additional rate, 25%, because there's a difference between 47 and 22. So that's where it all seems to be at the moment, confirmation awaited. I think it doesn't change immensely the bond collective offshore bond thing, but if to the extent where it does, I think could change it, is if you, to the extent dividends are driving the growth in that investment, then the shelter you get from that inside an onshore bond, because it's limitless tax-free dividends, and you get that full credit when it comes out, so you don't suffer that higher rate, is something probably worth looking at, I think, really. And we'll get lots more comparisons and case studies once we're absolutely sure from the regulation. Probably spent way too long on that, but it's an area I've been asked a lot about, and I think there's a lot of stuff that is pretty obvious from what we've read, and some other stuff that maybe isn't so obvious and isn't discussed as much, and that's one of them. I would say that dividend part is also relevant for people who own their own businesses. Clearly, dividends, salary, pension. The best practice hasn't really changed, even with the increase in the dividend rate. The numbers have changed, but it still makes sense to not take a dividend if you're a higher or additional rate taxpayer and your company is a 25 or 26.5% payer. It does make sense if it's a 90% payer. If you're basic rate taxpayer, it's probably best to take a dividend the whole time. Should I stop there for a bit, do you think, on the...
Yeah, no, thanks, Tony. That's really useful, actually. Because
there's loads more I can say about businesses, but I'll leave that for a minute.
Yeah, no, thanks. We'll probably come back to the wrappers piece, because as you mentioned, that tends to come up quite a bit in conversation, that onshore versus offshore bond piece. But yeah, maybe let's come back to that in a moment. But maybe just turning to Claire. I guess one of the questions, excuse me, that comes up is, is the pension still that accumulation vehicle of choice, or should people be considering other things in light of those 2027 changes?
I think we should always, back to that wrapper choice, not just the onshore offshore bond, but all wrappers. I think we should always be considering what's the best thing to invest in for both the short term and the long term. And obviously pensions is the long term issue. I still think they are the most tax efficient way to save if you use them for what they're intended. And as I said earlier on, one of the reasons for this pension change, for the introduction of pensions and IHT, is not about IHT. You've all heard me say this before. That change is there to drive behavioural change. It's to drive people to spend their pensions in their lifetime, which was the original promise made. So you get your tax relief up front, you grow it tax-free within the pension wrapper, and then the promise is I'll take it out and I'll pay income tax when I draw it out in my lifetime. So that's what they're trying to drive it back to, pensions being for pensions, supporting you in later life. So they are still tax efficient. There isn't really anywhere else where you're going to get that kick up the front to give you that extra tax relief to get that investment going. And then also you've got your employer contribution. So you should always be incredibly mindful of making the most of employer contributions. It's great saving into a personal pension, brilliant, but it's also great to make sure that the first thing you're doing is you're ticking off any matching. You're not missing out on any of that free money or free income from your employer. So making sure people are utilising that. Can always consolidate at a later state and get into a better, wider ranging choice of investments. But getting that money into the pension in the first place is really important. But once you've done that and you're considering what we won't be seeing going forward is people investing in pensions for legacy planning, which is what we'd started to see in the last 10 years with the changes. So we don't, prior to 2015, we did have death taxes. You start taking your income, then you would get taxation on death when it's taken out as a lump sum. But now, obviously, for the last 10 years, we've had this option to not only pass it down IHT free, pass it down income tax free if you're pre-75, but also leave it to anyone. And what they haven't done is they haven't removed that bit, but you can still leave it to anyone. But that's one of the reasons why we saw all this legacy planning. So people will be maxing out. You are getting back to the point that we're at the lifetime allowance, which doesn't exist anymore, I know, but in essence, the limits are still there. The lump sum and death benefit allowance is akin to that. And then the tax-free cash is 25% of the old lifetime allowance. So they all still reference the old rules, and we've still got those caps. So yes, pension's still absolutely incredibly important, but actually looking around for other options and other investment options, depending on your attitude to risk, depending on what you want to do. Am I going to put it into a cash ISA? Am I going to put it in stock shares ISA? Am I going to do something more interesting if I'm more happy to take the risks, such as VCTs, EISs, and all the tax benefits that you get with those as well? So there's lots of options, and utilising all of those gives you the best option later in life for if they change the rules again. Dare we say that that's highly likely, given the amount of changes there's been since I started the pensions industry, that we're going to see more changes. They do like to tinker with them. So getting that flexibility when you're investing is absolutely key to getting this right.
Yeah, thanks, Claire. I think that's really key. So, pension is still very much your first port of call, but there are other options available, and using your allowances as much as possible there as well. You touched on an interesting point as well. So, the purpose and goal of a pension, and also thinking about people wanting to pass down wealth. So maybe to you, Tony, I mean, what should people be thinking about in terms of those vehicles and strategies as intergenerational wealth transfer strategies?
Well, we know more people will be dragged into inheritance tax because that's the purpose of that, extending the threshold freeze effectively. We know that inheritance tax is a tax that is always polled through the YouGov poll as the most hated or most disliked, same thing, of all the taxes. So I think people are minded to do something about it. Nothing that we've seen in any of these changes affects when you've got cash, you can plan a lot easier with it. And to Claire's point earlier about people needing to keep something back for themselves or being a little worried about making outright gifts, which are clearly the best things to do. And we didn't get that. We were a slight worry around extending the accumulation period to maybe 10 years or maybe for lifetime, which would have made it much harder to do really effective lifetime planning, on the 7-year cycle. So all of that still exists. If you do need access and you've got cash, then you've got business relief solutions that still exist, £1 million, 100%, and beyond that, AIM shares and all that are 50%. No more detail on that for the minute. And then you've also got all your trust-based arrangements with loan trusts and DGTs, which everyone here will know about. And of course, don't forget protection to provide sums to meet the liability, and picking up on Claire's earlier point, funding that with premiums that will almost always satisfy the normal expenditure test. I would I'd emphasize that point that Claire made about keeping records and making sure that you know all of those gifts that you make, because you make the claim for normal expenditure on death in the Form 102. So it's really important. So 104, it's really important to do that. With that council, the high value council, it reminded me of how important it is, as if I was needed to be reminded of, that the property, the main residence, is in someone's estate. In most people's estate, it will form a big chunk for most. But there's not much you can practically do with planning for it to give it away during lifetime if you want to carry on living there and have it be inheritance tax effective. And we've been doing some work recently just doing the numbers, and the number conclusion still comes up as the same, given current interest rates. Releasing money from that property to make a lifetime gift still doesn't make monetary sense, commercial sense. If you looked at, will I be better off by taking money out and giving it away, having a debt on my estate, but having a rolled up interest commitment or even a paid interest commitment and the opportunity cost that you've got with the interest payments, rather than just leaving it where it is and then having the money passing over on death? The answer is probably still is better to leave it where it is, based on all sorts of assumptions and even on all sorts of survival periods, because of that rolled up interest. When interest rates come down, it might be a bit different. But what we've discovered through research is that the strength of demand for some people, and you've seen a lot written about this in terms of helping the kids, bank of mum and dad, getting kids on the property ladder, the strength and power of desire to do that will mean that for some it goes, this is a way I can do that, as long as I'm made totally aware of the cost. And I get the fact that in the long run, they'll be worse off. But what's the definition of worse off if they've got a property to live in and they wouldn't have had it otherwise and they'd have been paying rent? You know, you can do the numbers and go, they're worse off, but actually in the scheme of things, generally, it might be better off. So I think just it's worth a look, but with complete clarity around the numbers and being totally aware that it probably doesn't work out. But I think protection is something that people should think a little bit more of. You can plan without changing your life, really, then. So sorry if I went on a bit there, but it's something we've been doing a bit of work on recently. It was worth mentioning, I think.
Yeah, thanks, Tony. It sounds like it's very asset class dependent in terms of their strategy there. So whether it's cash investments versus property, indeed.
It is. Those general statements like do this, use that, use those exemptions, all very well. In theory, it does depend, as you say, Chris, on what asset you've got as to how practical that suggestion is.
Yeah, sure. And then just thinking, going back to the pensions piece, what about pensions life cover? Is that important, particularly in light of the changes? Maybe Claire, that's one for you.
You're talking about sort of using your pensions to check into. It's not something we really see much anymore, to be totally honest. So a lot of the benefits surrounding that really fell away in 2006. So it's something that we don't tend to see very much. I think it's really important though, if you're thinking about within the pension scheme, if you're talking about death in service, rather than anything. So death in service has been specifically exempted from the pensions and IHT changes. So we do need to remember that. They still need to tweak the legislation there. So we did see a lot of this when the lifetime allowance got capped and it started coming down. People started bringing it outside into accepted group life policies. And that's still really positive. They still work. They're not caught by the pensions and IHT changes. They're not a pension. But if people haven't done that and they've got death in service, so multiples of salary within a pension scheme, they are not going to be caught by these pensions and IHT changes. So they will not suddenly fall into the state. If you've got 10 times your salary, that's not going to be an issue. But do need to make sure you're planning well with that. So it's getting paid possibly to a trust, because obviously you've still got second death issues there. But it will still be tested against the lump sum and death benefit allowance in the same way it would have been caught underneath the lifetime allowance previously. So if you've still got significant funds, they could still be subject to tax because you're going to be pre-75 if you've got death in service. They could still be subject to an excess tax on anything over basically the 1.0731 million if you are earning enough, have multiples enough. So again, considerations whether accepted group life might still be an option there to actually remove those death benefits out into something that's not pensions that can be wrapped up and protected somewhere else.
Brilliant. Thanks, Claire. That's really useful. Lots of information there. Before we go to questions, maybe for each of you, maybe one or two calls to action. What should people be really holding front of mind and sort of starting to do off the back of the budget? Maybe start with you, Tony.
Okay, yeah, aside from generally, because the accumulation of change that we've experienced over the last couple of years, which at the time probably did seem quite big, but it may not have seemed as big as it actually is. When you put it together, it's actually now time. And I think some had been holding off doing this, a sort of full financial audit, as if my plan's still on track, until after this budget, because not worth doing anything until it's made clear that, and after the consultations have wound their way through. I think we have got a lot, that we'll have got the clarity we need, I think, for you to do a full financial audit on your financial plan. And just this point, I talked to a number of advisors about this, if effectively either yours or your client's business is their pension, as it were, and you're building that, fantastic, do that. There's a lot of business sales going on at the moment, consolidators and all of that going. Just bear in mind the importance of having intergenerational relationships to boost the value of your business. And second, don't forget the tax aspect. If for a government that says it's pro-growth and all of that, if you look at what's happened with the relief given on for business sale, and maybe this will change as a result of this call for evidence, but I just did a little sort of timeline. So in 2020, the business assets disposal relief was renamed, entrepreneurs was named business assets disposal. and the amount you could get relief on dropped from 10 million to 1 million. That's, to Claire's cliff edge point, that's off a cliff. Then we had the business asset disposal rate of relief, which was at 10%, which is great. It was much cheaper than capital gains tax, moved up to 14% in last year's budget for this year. And then it's moving up again to 18%. So, and then, well, anything else is subject to capital gains tax. And that's not so bad, except the rate has gone up to effectively, for people selling their business, 24%. So when you look at that, the importance of doing that tax efficiently, that sale, and maybe diversifying, leaving aside there being a market for your business. Second, realizing how much you're going to have left after tax and having money whilst your business is growing in other places like pensions. And it's fine. There's nothing to indicate that saving tax efficiently while your business is growing will have any negative impact on the value of the business, which is predominantly, founded on future income flows as opposed to how much is on the balance sheet. I would encourage everyone to think about diversifying, not saying you've got bad businesses, but relying on your business as your only means. You could be consigning yourself, and that may be great, to a lifetime of work and a lifetime lifestyle business, because you're not going to get enough from it when you sell it after tax. That was much too long a call for action. Sorry about that. Right.
Thanks, Tony.
Just on mine, yeah. I mean, it's getting in there, and I say this all the time to people: get in there and understand the pension schemes your clients have. What are the options? What can we max out? How are the death benefits going to be paid? Are there any restrictions? Also, what death benefit options are, because there's once the client dies, unfortunately, you can't change the scheme until the death benefit has been dealt with. So if the scheme doesn't offer drawdown, and that's what they're going to want because they don't want to take the income, because they don't want to pay the income tax, for example, then it probably needs consolidating into something more flexible. And we know there are a lot of those out there. If it's having that good understanding. And then what's the purpose? What is the purpose of the saving into the pension? Are we saving for retirement? Yes, or are we already too high and we're now saving for legacy? So we need to consider looking at alternatives that we don't need to, that aren't pensionable. So just having those options and those conversations. Because starting now, even though these changes aren't coming in, so that obviously the salary sacrifice 2029, we've got the IHT changes in 2027, and just a quick reminder: the normal minimum pension age goes up in 2028 from 55 to 57. So if people want to access their money early, at that point we're going to have some issues. Still some legislation to come on that as well. So understanding those and maximising where we can and utilising all those available options in the best way possible for each individual client.
Brilliant. Thanks, Claire. So I guess in summary, a number of these points really focus on cash now versus cash later. What are your sort of needs there? And really focusing on what the benefits you have at hand. So what are your options available? And to your point there, Claire, really think about what is the purpose? What are you trying to do? What are your goals? And I guess that financial planning process is so key to understanding all of those aspects. So just before we go to questions, just a few bits and pieces I just wanted to cover off. Firstly, just a recap here in terms of what we've talked about. So freeze on the tax thresholds, introduction of the 2% rate on dividends, savings and property income, cap on the cash ISAs, high value council tax surcharge for certain properties, didn't cover that off too much, reduction in venture capital trust relief, and that ability to transfer unused £1 million BPR allowance. Now, just before again we go to questions, a bit of a reminder of the tools and managed portfolios that we have at your disposal. So really here just to show the breadth and flexibility of our core managed portfolio suite. So we've designed this comprehensive suite to meet the diverse needs of your clients. So whether it's our sort of core active and passive range, as well as our specialized solutions such as ESG and income portfolios. But the key here is to really provide some choice and flexibility. And not to forget that we do have our multi-asset fund range, which are now celebrating their 5-year anniversary, which is great to see. So strong returns and of course offer CGT benefits for those looking to roll up their gains. Now, of course, thank you for joining today's webinar. Please do provide your feedback, and CPD and the on-demand will be available soon. Our survey is based on themes into 2026, so it'd be great to get your thoughts there. We'll also be sending a copy of the technical connection advisor and client guides to support your conversations. So with that, just turning to a few questions that we have at hand, and pretty much focused on what you've been talking about today. And one of them, Tony, as you mentioned, sort of the onshore versus offshore bond wrap. Great to get your thoughts here. So onshore bonds are definitely becoming more into vogue, but the availability of them has been very limited. So is the answer there your go-to should be offshore bonds as opposed to onshore bonds? But what's the thought there? Oh, you're just on mute.
I don't like answering questions. That's why I put myself on mute. No, it very much depends on the facts, as it always has, really. The underlying fund, where you expect to be, and what your tax rate you expect to be, when you cash in. And if you are or you can manage your affairs and your family's affairs to be able to draw money out completely free of tax, then there's a good chance of that. Then, as always been the case, you would definitely hold it in a place where there's no tax in the internal funds. That's an offshore bond, and you would then take it out in a way where there is no tax. You can use your personal savings allowance. You can use your personal allowance. You can use your zero rate, your starting ban, if you can, subject to all the conditions. Then it can make sense. But for those that say, that doesn't really apply to me, I'm going to have a massive pension, I am going to stay in the UK, I'm not going to sign it to a non-tax plan, it's for me, then you probably going to look carefully at the onshore bond, because the tax credit is worth having, because it's not available to the onshore bond or the offshore bond. And also the fact that credit is even more worthwhile when you look at dividends being taxed at another 2%. Not being taxed at all inside the UK Life Fund, but you getting a blanket 22% credit when it comes out, even though a chunk of the growth value, as has always been the case, has not borne tax, but now it's even more valuable because the tax rate that it would have borne had it been on the outside will be greater. So I think it mixes. And if you go, I'm not really sure, then there is, as there always has been, a good case for so-called wrapper allocation, as you would do in the investment world. Not sure whether bonds or equities are going to do better. Then you just, I might be this, I might be that, and not too scientific, but just have a foot in both camps if it's worthwhile. And the same with collective investments. You go, if there's a strong capital gain component, despite the increase in rates, most of the calculations you would do for a UK taxpayer would go, you're probably better off staying out of a bond, because the capital gains are still taxed. And that's why advice is so important. For relatively small sums, to be honest, it doesn't really matter. And if you're going to put them in trust, the bond probably gives you a much easier administration process, and you have those deferment opportunities. Some people do put GIAs in trust. They can be. It's perfectly fine. But advice is absolutely critical in this, I think. It seems like an easy thing to say, but it's absolutely right here, especially for larger sums.
And Tony, just adjacent to that, so beneficiary SIPs. So should we be thinking about sort of moves into onshore bonds post April 27 due to the IHT changes?
So I missed up. Beneficiary SIPs. Sorry.
Yeah. So think about
do you want me to pick that one up, Chris? I think it might be more my area. I mean, I think the issue here, if you've got a beneficiary SIP and there is no look through. So if you're talking about moving anything inside the beneficiary SIP onto an offshore bond, it makes no difference. There is absolutely no look through for IHT purposes. If you're talking about whether or not we should draw the money out of the beneficiary SIP, then you need to be mindful of the fact you're going to pay income tax on it when it comes out. If they inherited it when the client was post 75, if they're pre 75, then yes, I think there is definitely going to be an argument for if someone dies pre 75 and they're in a beneficiary's drawdown, for example, then drawing it out tax free and doing something with it. Because again, you can use it as drawdown income. There won't be any tax free cash, so we're quite clear it will be income. So you can utilize that as income, even though you're not paying any income tax on it, and then utilizing it possibly to put into a bonded trust, for example, to get it outside the estate, which in essence is second death, or it could even be further down the generations. What you do with that is, it makes sense. And I think that's a lot of people. I've seen people with very, very large beneficiaries drawdowns. We're talking millions of pounds, and they're drawing it out entirely tax-free and then utilizing it, as Tony mentioned earlier, as cash for IHT planning as well, because it gives you that ability to utilize that in a much easier way. Yes, within the SIP, you will get tax-free growth, but there are lots of options outside of it, because worst case scenario in that beneficiary SIP, the beneficiary lives beyond 75, they live beyond April 2027, then you get IHT, and then you get income tax on it on the new beneficiary as such. So definitely some thoughts there, and a good idea. Thank you, Anonymous.
Yeah, and thank you for that, Claire. And apologies for me going beneficiary SIP. Of course, it's that. So thanks, Claire. You said it better than I would have.
Thanks both. And whilst we're on the topic of products, so the other piece that's been coming up quite a bit in conversations is annuities. So how does the role of annuities fit in as part of all of this?
Yeah, I mean, I think we're definitely going to see more of them. We're already seeing more of them. I mean, the rates are a bit better than they have been over the last 10 years or so. And the ongoing income from an annuity does not fall into your estate. So you buy the annuity in your lifetime, then any ongoing, if you've got contingent spouses pension on that, is not part of the estate for IHT. So it will be subject to income tax. So that's just the way they work. So you will be subject to income tax and continuing. We need to make sure that we clarify here that if you buy an annuity on death, it will be tested for IHT first. So it's buying an annuity in your lifetime with an ongoing payment. Also, if you've got protected sums, so that if you have a protected amount that's been paid or a guaranteed income, so a guaranteed period, then they will also actually form part of the estate, the guarantee period, and any protected amount that will form part of the estate. So it's understanding the best way to set up annuities. But again, buying an annuity while you're in good health and using that for your surplus income requirements. So I've got surplus income because I've got an annuity and I'm going to gift from it, then it's quite clearly income. But we just need to be mindful. There are some rules about if you're actually you buy it when you're not well, short term, so take it straight out of the estate, and then you utilise that for the insurance, for example, then that can actually fall foul of. Are they back-to-back rules, Tony? Is that what I'm talking about?
Yeah, I was just going to mention that.
Yeah,
we've
so
had
just
some
need to be a
questions
bit
around
careful
that.
with those. But if you're perfectly healthy and you've got plenty of life left in you, then actually buying an annuity is not necessarily going to be a problem there.
Yeah, on that point, we've had some questions around availability of cash, maybe coming from pensions or just availability of cash. And with improved annuity rates generally, then just said, actually, is it worth going back to an old solution, which was taking that cash and making it with a purchase life annuity? That gets it out of your estate as a kind of 100% discount plan, and then replacing it. So you've taken it out of your estate, but then it's gone and it has no value on death, using the annuity payments to fund a life insurance policy in trust to replace it, hence the back-to-back. As long as both are done separately, independent underwriting could be with the same company, but ideally two separate companies, annuity, life assurance, independent underwriting, then that can work really well. From a normal expenditure standpoint, the capital element of that purchase life annuity payment doesn't count as income. But you just need to do the numbers, but you can see how it can work in theory. You go 100% out of your estate immediately, and it's not a gift because it will be gone immediately, and then replaced with a sum that is completely outside the estate because it's in trust, funded by premiums, the substance, but not all of which will be normal expenditure. So worth a look, definitely.
And just on that point, we've got a question here around an annuity. So if it's purchased, let's say, with 10 years left on it, but after 5 years, the individual dies, beneficiaries are adult children. Is there still IHT-free payments?
No, they won't be. So the capital value of those ongoing guarantee payments would form part of the estate, and I think it's interesting that they clarified this actually a couple of months ago when they revisited the policy statement and they came back with some changes that these would be caught. And I think the reason why they are caught is because you can commute them. So the opposite, if we can get them, we will get them. And so if you can commute it, or it's a fund that's remaining, then they will catch you. So in those cases, you'd have 5 years worth of payments that should be calculated for an IHT charge.
Brilliant. Thanks, Claire. And Tony, you'd mentioned something earlier on in the call around record keeping. I know this is quite topical as well. Could you sort of give some more information around that? What should that look like? How often, etc., just to make sure our advisors are keeping abreast of this?
Yeah, Claire mentioned this, in terms of keep records. It's in relation to normal expenditure out of income. So you don't claim it year on year on year. It's claimable by the personal representatives on death. It's page 8 of IHT 103, which is part of the death return that you make, that you fill in. And you would want evidence and records. You're best to have them, especially where you've got reasonable normal expenditure claims of what you make. So I would say, if you've got an Excel sheet or something, you just go amount that was paid out. Ideally, a clear record of the income that you had that qualifies as income, because the tests are, it's regular, which is proven by the payments that you make, and you've got records of that year on year, the payments made out, almost like little bank statements. And it's normal out, and it's out of income. So it's regular if it's made with an intention to be regular. Even if you intended it to be regular, life insurance premiums, you only paid one and then died, as long as it was clear that the intention. So another bit of record is, I'm starting this process. There was a recent case on it, its name I can't remember, where a lady made a very substantial gift and then died, but it was clear from the records that the intention was to make these substantial gifts every year, and it was, you know, based on the facts, but the records were really helpful there to show that there was a recorded evidence that that was my intent. It was a discussion with my lawyer, it was in my financial plan. You know, it was just the facts of the case. You can't sort of write that afterwards and pretend it was. So records, payments out, payments in, as it were, because the other bit, it needs to be out of income. And so showing that your income was sufficient and you're not relying on capital, also important to just have simple recording of it. Just if you've got that, you're in a good place, because you go front foot to HMRC to show this was it, and it didn't affect my standard of living. So not a detailed how much you spend on the milk and papers or whatever, if everyone buys milk and papers these days, but just that record, money in, money out, payments were actually made, what to, and intent is going to be great. That will stand you in good stead to have the backup you need to claim what could be a really valuable piece of exemption. You know, if you don't get it, then it could be years of cumulative payments that eat into your nil rate band when you claim it.
Good stuff.
There's some good guides around. If you just Google sort of normal expenditure claims procedure, a lot of the companies with protection plans and all the rest of it, so it gives you some really good guidance. HMRC, the IHT
manual, as I've said before,
very
is
good.
A good read.
Excellent. Yeah. Even TechLink, our very own TechLink site, has a very good set of what to do and what not to do, with appropriate links to the IHT manual that Claire's just mentioned.
Nice, perfect. We've just got one question here around situs. What is the treatment of a non-UK resident? They've got a UK SIP. They're out of the IHT residence, but they have that UK SIP. So how do we treat those assets? Are they UK citus assets, or are they not?
For me,
I'm going to go with you, Tony.
Yeah,
not for me.
I think I believe they are. So it'll be subject to any double taxation agreements that exist that can get a bit labyrinthine. You know, you can be, so the key test now, of course, since we've got rid of domicile, not as a thing, but as a test for tax liability in the UK, then you look at the statutory residence test and the definition of long-term residence for inheritance tax, and remember that long tail that can exist for up to 20 years, you know, of when you leave the UK, you're still on the hook for all your assets for a period dependent on how long you were resident in the UK before you left. So that gets quite complicated. If you aren't on the hook and you're satisfied, I'm definitely not, then the only thing that is potentially subject to inheritance tax is UK citus assets, is a UK SIP, a UK citus asset, and
highly likely.
It would be, wouldn't? Yeah, you think?
Yeah, I mean, it's going to be a driver, I think, for people who have left the country to actually really consider whether or not they're going to transfer their pensions overseas. Yeah. But we also really mindful of, when you're transferring a pension overseas, that your money needs to go to where you are, and you need to remain there. Yes. Because if you transfer that money to a different CUROPS jurisdiction, for example, flat rate 25% plus a test on the overseas transfer allowance. If it's going there, so it depends on the size of your fund, depends on where you are, depends on what you're doing, and it depends if you're going to stay there. Because if you do return back to the UK, it will still be caught anyway. Because even though it'll be a worldwide asset, you become long-term resident, it will then start getting caught yet again. So it's a big minefield, the transferring pensions overseas, and become ever more so every time they change a little bit of legislation around it.
Great question, by the way. That really good. Yeah.
Good stuff. Well, thanks, guys. I'm really conscious of time here. So thank you to our presenters, Tony and Claire, for those insights and contributions. They definitely play a key role in shaping how we empower investor success. Clearly, a number of things to consider when reviewing those client situations in light of the budget. So if you'd like more information, please do reach out. And with that, we will end the webinar there.
Could I just mention, if you are interested in our budget bulletin and all those bits we mentioned in more detail, of getting this in here, go to www.techlink.co.uk and get a free trial, and then you'll get access to all that stuff. Sorry if I shouldn't have said that, Chris, but it's said anyway.
Brilliant. Thanks all.
Thank you.